Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to find out if a company's a hidden gem or just a shiny rock. In this video, we are diving deep into Douglas Emmett Incorporated's latest annual report to see if their real estate empire is built on solid ground or just sand. Alright, so Douglas Emmett Incorporated DI is a big player in the real estate world, owning tons of office and apartment buildings in sunny Los Angeles and Hawaii. Think high quality properties in prime spots, but the big question is, are they making money and are they managing their risks well? Let's decode this filing. First off, revenues. For 2025, their total revenues hit over $1 billion. That's a lot of rent money coming in. Now, office rental revenue and tenant recoveries were about $686 million. That is pretty stable. But what is interesting is their office parking and other income jumped by 6% to almost $119 million. This shows they are squeezing every dollar from their office buildings, not just from leases, but from parking and other services. Now, when it comes to real estate companies, investors often look at something called FFO funds from operations. It is like net income, but adjusted for things like real estate depreciation, which doesn't really impact cash flow day to day. For 2025, their FFO was about $295 million. That's down from $345 million in 2024. This 14.5% drop isn't ideal, and the report says it is mainly due to lower office occupancy, higher office expenses, and increased interest expenses. That higher interest expense is a big deal, especially with interest rates on a roller coaster. They also talk about same property net operating income, or NOI. This measure helps compare properties they've owned consistently. For their office buildings, same property NOI actually dipped by 1.9%. This is because of lower occupancy, which means less rent coming in. However, their multifamily properties are doing better, with same property NOI going up by 6%. This shows their apartment buildings are holding up well, despite economic pressures. Talking about pressures, let's look at the risks. They are heavily concentrated in Los Angeles and Hawaii, which means economic hiccups in those areas hit them harder. They also mention the continued risk of inflation. This could mean higher operating costs for them and potentially higher rents, which might scare tenants away. They also have a substantial amount of debt, almost $5.6 billion. That is a lot of borrowed money, which can be risky, especially if interest rates keep climbing or if they can't refinance when loans come due. And speaking of properties, they own a massive amount of real estate covering almost 18 million square feet of office space and over 5,400 apartment units. It's a huge portfolio. They break it down into regions like Westside Valley and Honolulu. On the west side, they have about 10 million square feet of office space, which is a good chunk of that market. When it comes to tenants, they have a diverse base, but a big portion of their office tenants are in the legal, financial services and real estate industries. If these sectors face a downturn, it could really impact their rental income. For example, William Morris Endeavour is one of their biggest tenants, paying almost $18 million in rent, but they have an option to terminate their lease in 2033. That is a potential risk right there. They also have a whole section dedicated to cybersecurity risks. This is super important today. They say they have a risk management program, but admit that no system is perfect, and there is always a chance of breaches that could disrupt their business and lose confidential information. Looking at their debt again, it is massive, and a significant portion of it is floating rate debt. This means if interest rates go up, their interest payments will go up too, directly hitting their profits and their ability to pay dividends. They are trying to manage this by using interest rate swaps and caps, but there is still a risk. Now, for the balance sheet itself, total assets are almost $9.3 billion. On the flip side, liabilities are around $5.8 billion. The difference is equity, about $3.5 billion. Most of that debt is secured notes payable, close to $5.5 billion. That is a lot of loans. And what does all this mean for shareholders? For 2025, their net income attributable to common stockholders was about $16 million. That sounds okay, but it is spread across millions of shares, so their earnings per share is only 9 cents. This is down quite a bit from 13 cents in 2024 and a big loss of 26 cents per share in 2023. Investors need to be aware that overall profitability has been a struggle recently. So what is the verdict on Douglas Emmett Incorporated? They own prime real estate in attractive markets and their apartment buildings are performing well. They also have a strategy to gain significant market share in their chosen areas. However, the high debt levels, increasing interest expenses, and a slight dip in office occupancy and FFO raise some flags. Their huge portfolio, while a strength, also presents risks due to geographic concentration and industry-specific tenant reliance. The company acknowledges these risks and is trying to manage them with hedges and a robust cybersecurity program. But the bottom line is they are facing some headwinds. For us, the biggest takeaway is the balancing act between owning valuable assets and managing significant debt in a changing economic landscape. Their future success will heavily depend on their ability to navigate rising interest rates, control costs, and keep their office buildings occupied. Alright, that is our breakdown of Douglas Emmett Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.